Happy Friday the 13th and CPI day. It is 30 minutes to go until the start of your cash equity trade. I'm Danny Berger. Matt Miller on a well-deserved vacation. Bloomberg open interest starts right now. Coming up, an inflation report caps a busy week of economic data. Core CPI rising in January on higher servicing costs. Meanwhile, the AI scare trade came for a wide range of stocks this week. Literally everything logistics, that's just the latest victim. Plus another wave of earnings from EVs to pharma and food. We've got the latest read on corporate America. And one of those reads, Rivian, it delivered its first ever annual gross profit. The EV market otherwise has been pretty bleak, so good for them. Shares up 22.5%. We also heard from Moderna, those shares up 1.7%. Stronger than expected demand for its COVID vaccines, which was a surprise to all. And Wendy's, those shares getting pummeled. They beat expectations, but the outlook was disappointing. Cost-conscious consumers apparently looking for a bargain. Even though McDonald's beats, maybe Wendy's didn't lower their prices enough. One of the big stories this morning we are tracking, though, inflation rising at a slower than anticipated pace in January. Headline CPI's year-on-year increase was at 2.4%. That is the smallest since May. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, what was your read on the data?
Well, I'm a little more pessimistic than I think Wall Street is at the moment because everybody's pricing in more rate cuts from the Fed because CPI inflation is down. I'll tell you why that's not so good in just a minute. First, let's go over the numbers. The headline CPI just up 0.2 for the month of January, which is less than anticipated, and it's down from the prior month. And the year-over-year number falls significantly to 2.4%. Core up 0.3 as forecast, and so the annual rate 2.5%. The CPI rise, the smallest since July. We've sort of reversed the way inflation has gone this year in the CPI. But remember, PPI is still running at 3%, and that will figure into what I'm going to tell you in a second. The next data on PPI comes out next week. Biggest moves, gasoline prices were down 3.2% and rent up just 0.2%. Both of those, the biggest contributors to why the headline inflation came down. But tariff inflation is feeding through. You can see appliances were up 1.3%, video and audio 2.2%, computers and software up 3.1%. Those are all tariffed items, and companies had held off on raising prices, looks like in January they did. Now, here's the bottom line. If you're thinking about what the Fed is going to do, you have to remember that the Fed doesn't look at CPI. It uses the PCE index. And you can see what's happened to CPI. It's gone down. Remember, though, there was no October CPI.
Yeah, I was going to ask, just how distorted is this data?
It is distorted, and the government put in zeros for October. So CPI is not following the same path as PPI and as the PCE numbers. And PCE there is the yellow line. That is expected to be up 3% when we get the December numbers next week. And the Fed is not going to be looking to cut rates when inflation is going up at their on their target number to 3%.
Could you look at these numbers and say maybe less angst for the consumer? Food prices dropped. If inflation, when it comes to shelter, was less, gasoline was down. Does that at least signify maybe some pressure off of this White House, that some of those items saw less inflationary pressure?
If I were at the White House, I'd be highlighting those items because they're the consumer items. The issue then is what happens next. We had a big freeze in January that may have hurt some agricultural crops that could show up in food prices. And of course, gasoline prices being extremely volatile could be going back up again as well. So as long as that continues, it's good news for them. But if it doesn't continue, people are still going to be thinking about price level is still high.
Mike, thank you very much for breaking down the data with us. That is Bloomberg's Mike McKee. Now, elsewhere this morning, just moments ago, the Pentagon added a number of firms, including Alibaba, Baidu, and NIO, is aiding the Chinese military. Bloomberg Tech's Caroline Hyde is here to discuss. Caroline, what does that even mean to be added to this list?
What it means is that they believe that Alibaba, like Tencent was announced a few months ago, that they are in some way working alongside the military. What it means is that are we going to see forced selling from a number of the big ETFs, big BlackRock and the like, who own ADRs of the likes of Alibaba? Are they going to be forced to no longer hold on to these particular companies? Look, it's not on the entity list, but it is on this 1260H list, which is basically saying that they are in some way working or aiding the military. Now, Alibaba has come back and sort of more broadly has, according to Reuters, has responded saying that there's no basis to conclude that Alibaba should be placed on the Section 1260H list. Alibaba is not a Chinese military company, nor part of any military civil fusion strategy. But the worry here is that foreign investors are going to be less likely to hold the shares. We saw Tencent fall when this was initially announced for them. Alibaba's going to be having the same reaction in ADRs as well.
Shall we also discuss the disruption of karaoke companies, how they're apparently eating the world? I mean, yesterday on this show, we were looking at logistics and trucking companies' shares dropping, and we're trying to scramble why. It feels like every day there's a new announcement from some company, in this case, one that used to be karaoke company, disrupting some sector.
Yeah, in our show, we managed to find the why, and it was Algorithm, a $6 million market cap company that used to be a karaoke business, pivoted into the world of automated freight, and they put out a white paper. 400% increase in freight volumes without hiring any more people. Basically, freight is a really human organizational business, and they're saying we've got an AI tool that can cut that out. Look, would we ever have thought that this David and Goliath situation would be happening? Look, Altruist, we had the CEO of Altruist on yesterday. That is a wealth management company. It's worth $2 billion. It's VC-backed, unlike Algorithm. But we are seeing that it announced a new tool, a tax tool within its Hazel AI, and you saw $20 billion wiped off of wealth management companies. The AI anxiety is running rife at the moment. People are selling first, asking questions later. This is going to be coming for every single industry because most models are able to disrupt just the way in which we do our work yet more efficiently. But at the moment, the market's on tenterhooks trying to work out who it really affects and who it doesn't.
Do you think it's credible, though, that it's startups that are affecting things? Or is it going to be Anthropic? Is it going to be OpenAI? Are these the real words?
Algorithm, OpenAI are startups. Technically, they're not publicly listed. They're all eyeing going public. But what's interesting is it wasn't Gatik, which is a self-driving trucking company that has the backing of some of the most popular VCs and had joined our show a couple of weeks ago. It was a little-known karaoke company that had pivoted into making smart cab AI tooling. So I think the market's going to become a bit more discerning on what is the product that's really going to disrupt and what is the business model that's going to withstand that. But probably the likes of certainly OpenAI and Anthropic, they've got some incredibly powerful results coming out, and they've got some incredibly powerful platforms. People are going to be bracing for more.
By the way, Algorithm's such a good name because it was like rhythm,
yeah,
you know, karaoke.
As an algo.
It's perfect. Caroline,
.ai. We're all into it now.
We're all AI. Caroline, thank you so much for joining us. Tune in 11 a.m. Bloomberg Tech, where Caroline Hyde co-hosts. Now, Moderna earnings were boosted than higher than expected demand for its COVID vaccines this flu season. Bloomberg health reporter Jerry Smith joins me now. Jerry, I guess I haven't candidly gotten another COVID vaccine in quite a while. Why did they outperform in this area?
Well, I think this is a company that is, a lot of the investors are really focused on their flu shot. This past week, we saw that the FDA announced a refuse to file letter. Basically, they're not going to review the company's flu shot vaccine. This is a big setback for the company. Most of their revenue is reliant on COVID vaccine sales, which obviously have been declining since the pandemic ended. So the company's really trying to get more products, and this is a real setback where the FDA is saying, we're not going to review this. And the CEO of Moderna really made some extraordinarily sharp criticism of the FDA during an earnings call this morning, saying, there's a lot of regulatory uncertainty, not just for his company, for the entire drug-making industry, because we've seen a lot of examples of the FDA, companies saying the FDA is changing the goalpost. This new administration is giving us different feedback than the previous administration. So, companies usually don't criticize their regulator very sharply, but, Moderna's CEO really is coming out and saying, this uncertainty is harmful to patients.
That's what I was going to ask. Just how different is this FDA than the FDA under the Biden administration?
pretty dramatically different. You look at the top, and you've got Health Secretary Robert F. Kennedy Jr., who has been, very critical of vaccines, and that's just created a lot of challenges. And also at the FDA, a top official, Vinay Prasad, he's been a real stickler for, how companies compare their medicines in clinical trials. And so what we saw this week was, he said we're not going to review Moderna's flu vaccine because we don't like, the vaccine you compared your vaccine to. But, bigger picture, you think about the vaccine industry. Vaccines are very political right now, and it's creating real challenges for a company like Moderna that is right now entirely a vaccine company, hoping to become a cancer treatment company in a few years. It's a question of how do they get from here to there in a really tumultuous regulatory environment.
So a beat today and shares up, but the road ahead still looks challenging. Jerry, thank you so much for joining us. That is Bloomberg's Jerry Smith. Let's get a check on futures this morning, about 20 minutes in before your cash equity trade. We had gotten a lift up after CPI numbers that were basically in line. Supercore comes in, still a little bit sticky, so that leads us on our way to a fourth consecutive decline. The NASDAQ 100 underperforms, down 0.1%, while the Russell 2000, some outperformance there. That's up 0.25%. Let's look at some of the other individual movers on our radar, because there are a lot this morning. Expedia down 5.5%, even though it had the fastest fourth quarter revenue growth in 3 years. But it's the same thing that is hitting every single company, it feels like. Is AI going to displace your travel booking? Airbnb, on the other hand, sees healthy demand through 2026 as it plans to make deferred payment plans more globally available. Those shares up 6%, apparently not ripe for AI disruption. DraftKings sales and profit, those fell short of forecasts as it assesses the impact prediction markets will have on the business, shares dropping 12%. Coming up, rebuilding Venezuela's oil sector and how the U.S. can benefit. We're going to bring you our interview with the U.S. Energy Secretary Chris Wright. Anne-Marie was on site in Venezuela. That's coming up next. Stay with us. This is Bloomberg Open Interest. Let's get to high interest. A look at what's making headlines around the world. Kathy Ruemmler, the top lawyer at Goldman Sachs, is stepping down after renewed scrutiny over her past ties to Jeffrey Epstein. Newly released Justice Department files detailed her professional relationship with Epstein and expensive gifts, including a $9,000 Hermes bag that she accepted before joining the bank. CEO David Solomon said that he respects her decision. Ruemmler leaves June 30th. High earners in New York, New Jersey, and California are seeing bigger tax refunds this year, thanks to President Trump's new tax law, which raises the SALT deduction cap to $40,000. That change could save couples up to $9,600 and deliver more than $32 billion in total relief. The biggest gains go to households under the $600,000 in high tax states. Venezuela plans to hand new oil blocks to Chevron and Spain's Repsol as the Trump administration moves to loosen sanctions and boost production. U.S. Energy Secretary Chris Wright says new licenses are coming soon, potentially lifting output by up to 30% over 2 years. The move aims to revive Venezuela's battered oil sector and curb China and Russia's influence. Wright made those comments to Bloomberg's Anne-Marie Hordern.
The last 5 weeks have shown absolutely yes. We've worked very careful with interim President Rodriguez. She's made enormous changes very rapidly, starting January 5th. We already see a better business climate for Americans. We see smiles on Venezuelans' faces. We see local businesses here now optimistic about their future, talking about a return flow of Venezuelans if things continue on this path. So yeah, I think great optimism.
The president at one point said the U.S. was in charge of Venezuela. What does that mean on the ground practically?
I think it meant that 20-plus years of failed diplomacy have failed to change the trajectory of Venezuela. And now, with, again, a very groundbreaking approach, we have so much influence over Venezuela that we're able to nudge things in the right direction, maybe more than nudge. But I think we're aligned. What's in the best interest of interim President Rodriguez is to enhance the lives of Venezuelans. As society opens up and moves towards democracy, you got to be popular with the people.
Some might hear nudge and think leverage. What kind of leverage potentially does the United States have and is using?
The big leverage we have is we're selling the oil that's produced and exported from Venezuela. This has big advantages for Venezuela as well. We're getting more than 50% higher dollars per barrel for the sale of that oil. We're removing a lot of the corruption that was associated with that, and we're able to direct those funds to the government and people of Venezuela, but we have discretion about continuing to direct those funds. It forces us into a partnership to drive improvement in Venezuela and improvement in American-Venezuelan relations.
Chevron, where we are, has been in this country for 100 years, so they're ripe potentially to expand production. But what about others? Are you going to be releasing new licenses for oil companies to produce in Venezuela and expand production?
Absolutely. We've already released a general license for all American and, in fact, international oil and gas companies to come down, meet with officials, investigate possible deals, and then just come back to us when they have specific deal terms. We're releasing soon licenses that's going to allow the import of parts and services, so giant oil processing facilities like we're here can be upgraded and modernized.
Any new licenses or deals that potentially could be announced or that would be coming out of this trip specifically?
Well, Chevron is being enabled to massively grow their business here. They're the largest producer in Venezuela today, and they're going to be able to both expand the reserves they have and expand their operations. We're going to see a pretty good clip in rising Chevron production over the next 18 to 24 months in Venezuela. They're just one of many, but they're going to be a big one.
Energy Secretary Chris Wright speaking in Venezuela with Anne-Marie Hordern, Bloomberg's chief political correspondent and co-host of Surveillance. And she joins us now. Anne-Marie, what an excellent conversation. Loved the hard hats and the high-vis gear. Chris Wright talked about being able to produce soon. What does soon look like? Because I know after what happened in Venezuela, there was some skepticism on the timeline.
Well, first thing first, Danny, thanks for having me. And safety first. We were literally in front of a facility where that gear you have to wear. That's the Chevron rules. I mean, look, when it comes to quickly expanding production, it's going to be Chevron that's able to do that. And our colleagues reported yesterday that Chevron, Repsol are potentially going to get these new blocks from the Venezuelan government to start exploration. And then you heard it there from Secretary Wright telling us yesterday that more of these licenses will be coming down the pipe. So they will be able to expand production if you have a presence already on the ground. So that's Chevron, that's Eni, that's Repsol. The question, of course, is going to be coming from these other big players, like we saw with the president a few weeks ago, sit down with energy executives talking about their willingness to go in. Obviously, everyone was talking about what ExxonMobil CEO Darren Wood said when he said it's uninvestable. And then another moment, the ConocoPhillips CEO was talking with the president about how actually they lost all this money. They're owed billions of dollars from the government in Caracas after the government decided to nationalize the oil industry. And the president said, well, we should start with an even plate. That's a good write-off. What I took away from that interview yesterday is actually Chris Wright said that ConocoPhillips and other major players are in active discussions right now with interim President Delcy Rodriguez and her government about trying to recoup some of those funds, and that she said that she had some regrets about how things were done. So maybe trying to entice some of the bigger players back. What I've heard on the ground from officials that are there trying to reboot the embassy and also from Secretary Wright is that more U.S. government officials will be making their way down to Venezuela. There's a massive push to get there first, as well as I was told there's tremendous amount of interest from executives. So individuals want to be there. They want to see whether or not this could be an investable place, if they could put financial capital behind this, if they do see regulation there and stability in order to want to make that huge investment. The question is whether or not they pull the trigger. That is why the next few weeks are incredibly important. And that is just the business side of this, not, of course, all the politics that surrounded this meeting. It was just surreal, Danny, to be there. Tomorrow marks 6 weeks from U.S. Delta forces captured Nicolas Maduro, and you had the energy secretary there, the highest-ranking U.S. government official to step foot in the country since that happened, standing side by side with Delcy Rodriguez, the vice president. You know, I think a lot of executives are saying, is this a different boss but same regime? That's a big question.
To what degree did it seem like the acting president, Delcy Rodriguez, was on board with everything that the energy secretary was telling you, Anne-Marie?
Well, for her, domestic politics is also an issue, right? She sat down for an interview with NBC News and said that Nicolas Maduro is still the legitimate president. And Chris Wright says the U.S. government doesn't actually even say that this government is legitimate because of what happened, of course, with the overwhelming support from the opposition in the 2024 election. So for her, she needs to make sure that she is towing her party's line, the socialist line, that Nicolas Maduro is still legitimate president. At the same time, she was out in the fields with us the entire day yesterday. She is walking the oil facilities of these joint ventures between Chevron and PDVSA with Chris Wright. The entire day she spent with him. So it does seem like she is willing to play ball with this administration. There is a hydrocarbons law that they are looking to enact to try to get more investment in. There has been a release of political prisoners. There's an asterisk to that because there was one very well-known political prisoner. This was a hot topic while I was there, was released out of jail and detention, but then he was put on house arrest. This is something that the administration is pushing for. They want to see more political prisoners released, and they want to see a path, Danny, when it comes to free and fair elections.
Anne-Marie, again, really excellent reporting. Thank you so much for bringing us that conversation. That's Bloomberg's Anne-Marie Hordern back in the U.S. in Washington, D.C. Let's get a check on your future session ahead of the opening bell. We're less than 8 minutes away. Flat on the S&P to down. If we close down today, though, it would be the fourth consecutive day of declines with AI anxiety. Everyone seems to be picking through every press release. What's the next thing to get hit? The NASDAQ underperforms, down 0.1%, while the Russell 2000 outperforms, up 0.3% as this market prices in 50% odds that we will get 3 rate cuts. Only a few moments to go until your opening bell. This is Bloomberg. Less than 5 minutes ago until the start of cash equity trading, Applied Materials, one of the leaders this morning, up nearly 10%. Demand for high bandwidth memory is surging, and that boosted its output and its earnings for the quarter. Meanwhile, there's Coinbase. It's rebounding. Investors looking past the crypto rout and its revenue miss this week, so that rebounds up 9%. And then there's Pinterest. It issued a weak outlook for its ad sales as it prioritizes AI use on the platform. And less than 4 minutes to go now until the opening bell. Moneta's Aoifinn Devitt is leaning into value as AI disrupts industry groups. She's going to join us on what exactly she's picking up next. This is Bloomberg Open Interest. Just seconds away from the start of trading. This is Bloomberg Open Interest. I'm Danny Berger. You're looking at an equity market that is little changed at the open, as is the NASDAQ. At first, we got some relief because CPI wasn't as bad as expected, but maybe Supercore is troubling. Maybe it's the AI trade that's eating everything. Russell 2000 futures, those are up 0.33%. For the bell ringers, down at the New York Stock Exchange, we have Black History Month being celebrated by BlackRock and the Black Professional and Allies Network, which is a wonderful thing to see. We also have another foundation down at the NASDAQ. This is the Heart Speaks Foundation. I believe at the center there is a woman named Sharon Bond, herself a survivor of a heart attack. So we commend all of them on their exercise. Red, I believe, is the color of heart wellness and the philanthropies behind it. So I'm so happy to see that they are all on brand. Okay, let me show you what some of these equity markets are doing. Equities are doing at the open. Rivian, really strong earnings for them. It's first ever annual gross profit, and that is a bright spot in what otherwise is a very bleak EV market. They're also putting out new, cheaper SUVs. Matt Miller would be here and tell you all the details about it that I do not know, so I'm sorry for a poor imitation of Matt. Moderna, those shares up 4% at the open. It beat on its fourth quarter revenue, stronger than expected demand as well for its COVID vaccines, in a company that's trying to expand beyond that. And then there's Wendy's. Those shares are trading up 2%. They were falling in the pre-market because there were some concerns they didn't do as well as McDonald's. Now they're up nearly 2%. They did have an earnings beat for the past quarter with cost-conscious consumers looking for bargains. It was their outlook that was a little concerning. But but everything's okay now, up 4%. So there you go, McDonald's and Wendy's apparently doing well. It's a lot to dig through in this market. Let's bring in Moneta Global Wealth Managing Director Aoifinn Devitt. Aoifinn, we got CPI, but it still seems to be like this AI angst that's really weighing in markets. How are you wading through the press releases from Anthropic, from startups that keep seeming to hit different sectors? Are you reacting, or is it just noise you set aside?
Well, good morning. It's certainly not just noise. We have to look at how this is cascading through different sectors. It hit our sector just this week, private wealth. There is definitely a sell first, ask questions later type of mentality. And when it comes to the other noise we're seeing, I would say that this is a surprising inflation print. Good news for consumers, but probably bodes well for further rate cuts. And we have always been forecasting 3 at Moneta. So a lot to contend with, a lot of news flow. But as we can see from this movement, still a reasonably high appetite for equities out there.
So what are you looking for then? What can you pick up?
Well, we've been very focused on the picks and shovels trade for a long time. We've been saying it for so long, it's almost become kind of a drumbeat for us. Looking now at grid tech as well, I think Bloomberg actually coined that whole index because we know that there has been an underinvestment in the grid. And the one thing that is true wherever you look is that we do need more energy, more electricity. Look at Coinbase today, up 10%. Bitcoin is still really languishing at these low levels. But what we do know, and we know this from financials, is that you still need to trade these assets. So finding really that is a picks and shovels trade as far as we're concerned.
What about a wider, if I can jump in, Aoifinn, what about a wider value trade? Because there has been some of that rotation to start the year with the momentum, growthy, high flyer names getting extremely volatile, having some weeks where everything that won last year is getting hit. Is it a time for a rotation?
Yes, we do look at value as being quite interesting today. We don't expect the rotation to be long lasting, however, because growth has captured the imagination of stock market investors, and we know that they are definitely not going to want to avoid growth completely. However, we've always suggested broad-based growth and value exposure. If you look at some of the value names, whether that's in healthcare or in retail, they are doing quite well. We know there is rotation away from tech because of that angst that you cited earlier. And that angst is very well placed, we believe. There is tremendous uncertainty around these large amounts of capex. And equally, we know that when the certain sectors like software will be disrupted by it, there's still some question marks regarding the domino effect within AI and chips in general.
Even one of the things that I've seen a lot of folks be concerned about is a parallel to the 2000s. And yeah, valuations, bubble worries, whatever. I know that's been talked about a lot, but this one feels a little bit different. The idea goes that in 2000, you saw an enormous rotation, that you started to move away from the tech stocks. And 6 months or so, you saw a rotation, and that was enough to keep the S&P 500 flat. But eventually, without the leadership of tech, gravity took over, and then you had the bubble burst, and it was extremely painful sector-wide, market-wide for the equity indexes. Could something like that repeat if we don't have big tech and maybe software stocks, maybe even semis? Those have been holding up. But if we don't have some of that acting as market leadership, could it really cause damage at a headline level?
We would share that concern. I think it's an excellent point. What has been really the story of the strength and resilience in markets has been tech and AI. But for those stocks and the really large percentage they're representing, the market is very lackluster until just recently. So there's definitely a bit of catch up being played. And it's true that the consumer has been generally on the back foot. But with this low inflation number, we'll get a little bit of support with these tax incentives. The reason I mention the consumer, as it's the consumer that props up these other stocks across the board. The consumer is not generally propping up the AI stocks. That's mostly enterprise selling, a little bit of consumer-wide selling. Yes, there could be a correction like in 2020. We say having global exposure, having broad-based exposure across all caps, all sectors, that's one way to insulate against that, but it's not going to be fail-safe.
Is there a scenario, though? Okay, so the AI anxiety at the moment, it's very much so a narrative on Wall Street. What happens, or could it happen, that narrative spills into Main Street? It's in America that has a relatively low savings rate. Could we start to see consumers concerned that their very own jobs are going to disappear, start saving more, start acting in a way that could really damage what otherwise has been strong spending? I mean, last retail sales was a little bit stagnant, but otherwise has been strong spending from consumers.
That's an excellent point. Fear really sells, and certainly fear has been percolating through social media. Just this week, there are various viral articles. Every week there's a viral article. Last week it was Moltbook. This week it's the sense that we've no idea as to what these new models are capable of, and we should all be looking around the corner to see if our jobs are safe. As I mentioned, it hit private wealth just this week. I'd say actually the consumer is aware of that. I'd say added to that is a fear that they don't really have sufficient proficiency with these tools, and so that they almost don't know what they don't know. And I would say that is already hitting Main Street. And Main Street certainly is aware of the narrative. So as to whether it could get worse from here, that narrative, I think it probably can. But I would say that certainly Main Street is already aware of that, and they're feeling that on the job side.
How does the macro data fit into all of this? We got CPI today, mostly in line, maybe allows the Fed to cut more. The jobs numbers were very strong. There are 2 and 3 and maybe 5, maybe 10, maybe a million different narratives going on. How do they all fit together?
It's really interesting. I'm sitting here in Europe, and Europe has had this low inflation number for some time. Not, mind you, in the UK, where I am currently, but there is the 1.7% number that allowed Europe to really get comfortable that they could cut rates further. They're stable for now. And there was a sense that that was maybe a very safe place to be when it comes to the economy. So what I say the biggest concern that's out there right now is this rising level of the budget deficit, basically this fiscal situation that is really pervasive around the world. And why do I say that's important? Because that is what drove the gold price, and that is driving a dollar debasement and a flight out of U.S. assets at the margin. It is not a wholesale flight out of U.S. assets. So I'd say that is a fairly strong macro story. Equally, what the Fed is likely to do next. It has this twin challenge. Jobs are strong, the economy is hot, and now it has inflation softer. So whether that will be sustained or not, there was a spike out of Norway this week, not a particularly notable economy. However, it does remind us that inflation can be volatile, and we should not perhaps get too complacent.
Aoifinn, thank you so much for joining us this morning. I suppose afternoon for you in the UK. Enjoy your weekend. That's Moneta Global Wealth Managing Director, Aoifinn Devitt. All right, about 9 minutes into your trading day, it's interesting to see, even though yields are collapsing on the front end of the curve, down 4 basis points after that CPI data, that's not helping equities this morning. In fact, even tech is underperforming. Let me start with what's underperforming, because typically you'd assume yields come in, maybe that helps tech a bit. It's not happening. And this is why the entirety of the market is falling, because NVIDIA is down 1.4%. Angst as we get closer to their earnings on February 25th. Apple, Meta, Alphabet, Micron, all those shares are down. Amazon, so a lot of the Mag 7 to the upside. And this is why the equity market can't sustain itself. It is somewhat smaller companies, not totally small, but Applied Materials, they had some really strong earnings. 13% is their rally. Eli Lilly, General Electric, Merck & Co., all those doing well. And because of that, if you look at the sectors, you will see healthcare the best performer. It was good earnings from Moderna, so that's helping. Healthcare is up about 1%. Industrials, real estate. Even Devitt was talking about the fact she wants to own the picks and shovels, so you can see some of that down there. Communication, that's down. Alphabet is also down this morning. Financials, they've been chronically underperforming so far this year, so this is an equity market which is down slightly so far here just after your open. Coming up, we're going to speak about one of those earnings I mentioned. Applied Materials, the latest chip maker to issue a rosy outlook as AI fuels demand. We're going to discuss that and much more with Mandeep Singh. That's coming up next. This is Bloomberg. You are watching Open Interest and looking at the Principal Room. Coming up at 10:30 a.m. New York time, an interview with Jim Cantrell, founding member of SpaceX and CEO of Phantom Space. We're going to talk data centers in space. This is Bloomberg. Let's get you some top calls, the analyst action we are watching this morning. First up, Deutsche Bank, they've upgraded Airbnb, calling the risk-reward compelling. The firm expects AI-powered search to lift bookings and believes Airbnb is more protected from peers than potential AI disruption. Shares up 6.5%. Expedia, by the way, slammed today on their earnings and for concern of AI. Pinterest, that's getting a raft of downgrades on Wall Street after issuing a weaker than expected first quarter forecast. Baird and Evercore ISI cut their ratings ratings on the stock, pointing to soft advertising trends and slowing growth. Shares down, ouch, 21%. Finally, Applied Materials is getting raised at KGI Securities after the chip equipment maker beat expectations and guided higher earnings. The strong results prompted analysts to lift price targets. Morgan Stanley says the beat and raise represents a leap, not merely a step. Shares up 12%. Let's discuss those earnings and all things AI with Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh, who's been working overtime. Mandeep, I look at earnings like Applied Materials, and my first thought is, why wasn't that already in the price? We know that the chip sector is hot, be it both analog or things that go into AI. So just how much did they surprise to the upside?
I think the dynamics you're seeing in the memory side are also showing up in Applied Materials results. And, memory and semicap equipment have been two sectors that have done really well this year, partly because of all the component shortages and, the fact that, you are seeing demand for NVIDIA chips and Google TPUs. But when it comes to HBM, DRAM, NAND, semicap equipment, all these sectors are seeing positive revisions to their estimates because of the pricing, because of the shortages, and that's what's reflecting in the stock reaction. Because you're right, I think some of the estimates had gone up, but it's the pricing side that's kind of delivering the above consensus numbers.
I just wonder how many people expected this year so far to shake out as it has on the AI trade. Mandeep, it's a weird world we live in when a $6 million market cap, previous karaoke company, now AI trucking company can disrupt an entire sector, or other startups can disrupt tax advice, or a company you've never heard of also impacting an industry that has been a mainstay. How much of, specifically from the startups, and we can get to some of the OpenAI Anthropics in a moment, but is this where real disruption is going to come from for a lot of the sectors? Is it small startups who can produce some sort of AI type thing that weighs, and we're looking now in the trucking sub-index for the Russell 3000?
I mean, some of the sell-offs have been driven by, the fact that these valuations were stretched across a lot of sectors. And I could make the case for software, for, some of the trucking names. Now, partly that had to do with that AI narrative. And now what we have seen is with Anthropic, showing their revenue run rate, clearly they have a lot going for them in terms of, a very strong model release. And on the LLM side, I would say things have really progressed well year to date. And, some of the panic is partly to do with the fact that how successful coding agents and applications built on top of those coding agents have been. And, whether it's going to be all small companies, it's TBD, but there's no doubt that there is real change happening when it comes to, some of these applications that are built on these coding agents.
Well, I guess that kind of gets at what I wanted to ask, which is who is leading the change? Is it startups? Is it VC? Because VC has been plowing money into AI. Or is it just going to be Anthropic, OpenAI, Alphabet? Are those the real disruptors?
So just look at Anthropic's numbers, and they had a $30 billion round yesterday. I mean, they've gone from $10 billion to $14 billion in a matter of 6 weeks. They added $4 billion in revenue that your, large cloud providers like Amazon, Google, Azure add in a quarter. And so from a growth rate perspective, I mean, if this is their run rate, I wouldn't be surprised if they're north of $25 billion run rate by the end of this year. And there are very few software companies we know that are over 10 billion. So they've gone from nowhere to, north of 20 billion plus in ARR. And that's the kind of growth that is unprecedented. We have not seen those kind of numbers and growth rates before. So that's why you're seeing, the LLM companies really leading the charge here.
Yeah, and the funding rounds for Anthropic are literally a who's who of the world's biggest investors. Mandeep, thank you so much for all of your work this week. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, it was a round trip week for software services ETFs. We're going to discuss with the man of the industry, Eric Balchunas of Bloomberg Intelligence. He's going to join us next. Stay with us on Bloomberg Open Interest. Welcome back to Open Interest. About 20 minutes into your trading day, let's get a check on where these equity markets stand, because we are on track for a fourth consecutive day of declines. S&P and NASDAQ pretty evenly matched in just how much they're declining, down 0.1%. Interesting to see small caps. They are outperforming, but maybe that's not a surprise. We got CPI data that came in basically in line. I was looking at Omer Sharif, though, saying that underneath the hood, there were some concerning things. I know some of the goods inflation maybe was stickier than expected. The Dow Jones, someone tell Pam Bondi, we're back under 50,000. That's very sad news. Down about 1/3%. Bloomberg dollar spot, little change. Again, as I mentioned, yields, those are coming in after the CPI data, which is helping the small caps. Nvidia, those shares are down 1.5%. It's getting thrown out with the AI anxiety. I did see that OpenAI released one of its first models not using NVIDIA chips. I wonder if that's leading to some of the anxiety. Will they have real rivals? Applied Materials, strong earnings from them, a sales forecast that crushed estimates. Rivian, also really strong earnings. Their biggest jump at the moment since 2024, if this holds, up 20.5%. Really strong delivery forecast, and there had been so much anxiety around EVs. Again, Matt Miller could tell you all this better than me, but all the big companies have had to pull back, and even companies like Porsche struggling with EV sales. So the fact Rivian can get out some pretty attractive SUVs that people will buy, a good sign. Coinbase, those shares up 8.6%. There's some crypto bill optimism. It's also rebounding after a tough week. And then there's the ETFs. I showed you what the S&P is doing, so it makes sense that the VOO, the Vanguard S&P 500 ETF, is also down, but it is on track to hit $1 trillion by September, apparently. And then there's the iShares ETF on software. That is up 1.3%. But look at what it's done over the past 5 days. I have to say, if you didn't look at this and I were to ask you, okay, what did the main software ETF do in the past week? You'd probably be like, it's been crushed, it's been horrible. To be fair, only being down 0.5% for a week that's been filled with anxiety is probably a good thing. Let's talk about how this fund and others are coping with the AI impact scare. Joining us, pleased to say, is Bloomberg Intelligence Senior Analyst Eric Balchunas. Eric, so great to see you. I was also looking at the flows. It seems like a lot of people are buying the dip on the software ETF.
Yeah, a lot. There's a lot. When it comes to these sort of like sector or industry ETFs, these are not really used by mom and pop or advisors to go long term. They're used by traders. And traders love to play the rebound, especially when something gets volatile. It's like chumming the waters for traders and degens. And this ETF particularly has gone down a lot. And it's really uncoupled from like the Qs. Like the Qs is up a lot over the past year. This is down a lot. And I think some people, this is capturing this moment of this AI fear. These stocks seem to be the most vulnerable. So this thing is, quote, in play. And so the volume is ridiculous. I mean, this thing has traded over 10 billion the past couple of weeks. It normally trades like, a billion, right? So it's about 10 times its average volume. And, for now, it's going to be kicked around like a soccer ball. But the flows tell you people are playing the dip here. They think it's probably oversold.
We also, because one of the big trading things we've seen is everyone coming through announcements from AI startups and trying to figure out what industry is being impacted from it. Obviously, software is a big one. Trucking was one yesterday. Is that also being done from ETFs, these subsectors where there are concerns about AI impact?
Yeah, software to me is probably the most vulnerable. But another one that I want to go the flip side, the one that we've seen a lot of optimism for is the uranium miners. URNM is up a ton. It keeps going up and up. And it's because they're going to use nuclear plants to power all of this AI facilities, or the AI, the energy that it requires. So it's a backdoor AI play. So AI definitely is sort of shifting different sectors, different areas. And of course, there are AI ETFs out there. And every time I look up, another one has $1 billion. So there's, people are, the issuers are, it's not lost on them. And now there's a lot of like 2X stock ETFs that go either long or short the AI stock itself. And this is creating a lot of volume, mostly, not a ton of assets, but a lot of trading activity.
Speaking of popularity, quickly, Eric, I know you've been tracking the rise of VOO, Vanguard's S&P 500 fund. You and the team writing it's likely to hit $1 trillion by September?
Yeah, this thing is a juggernaut. I am going to officially describe VOO and chill is America's trade. Everybody I talk to is like, yeah, I just VOO and chill. And it shows up in the flows. This thing has taken in $25 billion this year. It grew by 250 billion last year. That's $1 billion a day in asset growth. We've never seen anything like this. ETFs used to take in 250 billion a year. This ETF alone is taking in that much. And it's really because it's low cost, cheap, trusted brand. It's hard to beat it.
All right, Eric, thank you very much for joining us on this Friday. Eric Balchunas of Bloomberg Intelligence. And by the way, catch Eric on ETF IQ. It will be airing next Thursday at 12 p.m. New York time because Monday is a holiday. Coming up in the next hour, Barclays U.S. economist Pooja Sriram on CPI data. Minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger. Matt Miller probably off in Disney World somewhere enjoying a much-deserved break. We are on track for a fourth consecutive decline for this S&P 500. If we do that, it will be the first time of this year. Coming up, an inflation report caps a busy week of economic data. Core CPI rising in January on higher servicing costs. Meanwhile, the AI scare trade came for a wide range of stocks this week. Logistics, those become the latest victims. And AI anxiety spills into the IPO market. Wall Street broker Clear Street postpones its offering, citing market conditions. We begin with the CPI print. Tiffany Wilding of PIMCO spoke about her takeaways from the report on Bloomberg Surveillance.
Shelter inflation, which had been stubbornly just persistent since the pandemic, it's finally really decelerating. And we saw that in today's report. Rental dynamics for new tenant rents actually suggest that you're seeing a pretty stagnant rental market, and that will ultimately feed into OER with a lag. So that's good news for the Fed. I think the other good news in this report, is that the tariff-related effects are largely fading.
Joining us now is Ed Harrison, senior strategist for Bloomberg and author of the Everything Risk newsletter. Ed, immediately you get some chop, but mostly it's relief. Front-end yields come down. But we got to talk about the title of your piece this morning. Soft CPI hides inflation risk for a complacent bond market. Where is that inflation risk in the latest CPI report?
Hey, Danny, good to talk to you. I think it's it's actually in tariffs in particular. So to disagree with your guest from earlier, the reality is that a lot of firms have waited to see the permanence of tariffs, and they're starting to pass it on. You saw in the Fed Beige Book that more companies are passing it on now as opposed to in 2025. And then we also have the immigration issues where none of that has been felt in terms of inflation thus far, in terms of increased costs for companies as a result of lower immigration and people actually leaving the country. So those are things that are going to be felt in 2026. And that's going to be a problem for inflation going forward.
So what does that mean for this bond market, Ed, which at the moment is in rallying mode and adding to expectations that we may, I think about 50% odds now, get a third rate cut this year?
I think it means that, there's not much further that we can go in terms of the rally. If you think about from September to January, we were in a very tight range between 4% and 4.20 on the 10-year. We dipped below that range on one or two occasions because of fears of a recession. But, that's the range that we were in, and we're back in that range again. You're really not going to be able to get sustainably below where we are now, which is about 4.7, 4.08 on the 10-year, unless those growth concerns come back into play, and they're not here, as virulently as they were at the end of last year.
Ed, what about just the issue of the reliability of this data, of skipping an October CPI report, of having a delayed one, of having a delayed jobs report? Is it even really possible to glean, one, where the economy is going, or two, what the market reaction will even be when some of this coming in is still quite foggy?
Yeah, that's a great point, Danny. I think that it's difficult at this point. And I think, when you look at the AI scare, a lot of that is tied into the fact that we don't have enough data. We don't know what's happening with the economy, where AI is going. There's a lot of debt. Some of it's in the private markets. There's a lot of of uncertainty at this point. And as a result, I think that you see this churning, and that's also going to reflect in the bond markets as well. That's the safe asset, and so staying within the 4% to 4.20 range makes sense, except when there are growth scares on the downside for yields, and if there's an upside in terms of growth above 4.20.
Ed, we appreciate your time. That's Bloomberg's Ed Harrison, author of the Everything Risk newsletter. Highly recommend you subscribe and give it a read on your Bloomberg terminal. Let's continue the conversation. Joining us now is Pooja Sriram, U.S. economist at Barclays. Pooja, great to see you. I first would just love to get your take on CPI. Was this one of relief for you or one of inflation scares beneath the surface?
Hi, Danny. Thanks for having me. I will say, very mixed readings. So at the top line level, it did come in weaker than expected. Core inflation at 0.3%. In fact, one of the very few Jan prints that surprised markets to the downside. I think most were bracing for a pretty hot print going into today. Now, why do I say mixed? Because relative to forecasts, I think, the big miss came from used car prices, which were down substantially. But you sort of take that out of the equation, and you still see core goods, excluding used cars, slowly ticking higher. And to me, that is really a sign that the tariff pass-through continues, much as we had expected. I think I agree with, what your earlier guest, spoke about, that tariff pressures are not done. In fact, we agree with the Wall Street Journal article that there is, the importers have, seemingly borne the brunt of tariffs, and it's perhaps now that prices are likely to be passed on to consumers. So I think that is one area which, to me, suggests that there is more inflation risk. And then turning to the services side, pretty strong core services print as well. I mean, at 0.4% month over month. We do see this modest deceleration in shelter, which is, well anticipated by markets, and we think that continues. But outside of that, we did see a bunch of firm prints here and there. Airline fares, I'm sure a lot of people noticed, were up 6.5%.
I have to say, just listening to you, Pooja, that doesn't sound like it should give the Fed much more comfort or much more room to cut this year.
I think it's too early to say that. Look, I think the tariff effect is likely to fade in the next couple of months. Our own estimate is that about 60% of the pass-through has occurred in 2025. There's perhaps another 40% left. We saw some of that this morning. Maybe we see some more pan out in the next couple of months. But by the second half of this year, we could very well be in a world where core goods inflation subsides, core services continues a gradual downtrend, with shelter being a big driver of that. And in that world, inflation, at least on a month-to-month basis, looks more target consistent than it does recently.
Pooja, the other source of anxiety in this market has been AI. And at the moment, it feels like a Wall Street narrative. Is there a risk, and we were talking about this earlier with Aoifinn Devitt from Moneta, that it becomes a mainstream narrative, that you have consumers already with a very low savings rate start to save more and start to spend less?
Right now, I think we're still very much in the build-out phase for AI. With all the capex that's been announced, there's actual construction that's yet to happen. And our view is that it actually proves to be, quite supportive of employment growth, at least in certain sectors, especially with the sort of labor that you need to build and maintain these data centers. So I think so far as we're in the build-out stage, there is still some support for labor markets. But I think the concern really is how quickly could productivity gains start displacing workers. And I think right now that is, clearly a tail risk, but not really part of our baseline.
But is it your assumption, though, if we start to see something like that, governments will step in? I mean, we saw them step in during COVID. How bad could it actually get if jobs start to seemingly be replaced from AI? Are there backstops to that, Pooja?
Well, I think regulation is a big question in this sector, right? And I think that is a concern. Can we reach a point where there is complete automation, in which case you would have massive job losses? And I think that is something that is yet to be thought about. But in that world where, let's say, you do get that, I think you would need both fiscal and monetary policy to step in to support the economy.
Pooja, wonderful to see you this morning. Enjoy the rest of your Friday and your weekend. Pooja Sriram of Barclays. A check on your equity markets this morning, about 40 minutes into your trade. And congratulations, we're positive. Will it last? Who knows? We've had a lot of chop so far this morning, but hovering around unchanged. Now the Nasdaq slightly outperforming, up 0.1%. 10-year yield, some of the fall ebbs down about 3.5 basis points at 4.06. The front end of the curve falling more as we price in the potential for more rate cuts after an inflation that was in line, but as Pooja was just talking about, some concerns under the surface, especially when it comes to core goods. Some of the single stock movers this morning, Moderna beating fourth quarter revenue estimates thanks to stronger than expected demand for its COVID vaccine, shares up 7.75%. Wendy's, they delivered a disappointing outlook as cost-conscious consumers look for bargains. But shares now in a huge rally mode after falling in the pre-market, up 6%. To be fair, their previous quarter did beat, so maybe that's the good thing for them. Rivian, those shares up 20.5%, better than expected results from its first ever annual gross profit after years of consistent losses. Coming up, the Department of Homeland Security faces a weekend shutdown as funding talks collapse. We're going to bring you the details from Nathan Dean. That's coming up next. This is Bloomberg Open Interest. Every Friday, Bloomberg's Nathan Dean breaks down the key events in Washington and the catalyst investors need to watch. And today, we are discussing the looming shutdown of the Department of Homeland Security after Senate Democrats blocked a funding bill. We are honored to have Nathan Dean with us, giving us a preview of next week. Nathan, it seems inevitable that this shutdown is coming. What would it actually look like this time around?
So this is a partial shutdown. This is the Department of Homeland Security, which includes FEMA, TSA, ICE, and so forth. And this debate is really about ICE tactics. It's not so much about ICE funding. It should be important to note that ICE funding was taken care of by President Trump's One Big Beautiful Bill. They're funded through fiscal year 2029. Now, what it really means for those of us in the markets, well, two things. One, there's really not a much market impact from this. Maybe eventually if TSA workers call in sick, you could see some airline disruptions in a couple of weeks. But the message that we've been telling our clients is that the rest of the government, the other 11 appropriation bills, is funded through September 30th. So if you're concerned about things like lack of BLS data or any other type of government, contracting and so forth, you're good through September 30th and probably through March 2027. But the other thing is for every day that Congress is spent debating DHS, it's a day that they're not spent debating things like crypto market structure or housing. So there are smaller bills out there that are effectively being delayed because Congress is still focused on DHS.
Where does that debate stand, Nathan? Clearly enough of a loggerheads to prevent a funding bill from going through. But where are these conversations? Are they getting anywhere, I suppose?
So they're not getting anywhere. I mean, obviously, Congress left. A lot of members of both sides of the aisle flew to Munich just for the Munich Security Conference that's taking place this weekend. But the next step is really to have a counteroffer from Senate Democrats under, Minority Leader Chuck Schumer back to the White House. Now, this debate isn't so much about funding, like I just mentioned. It's about tactics. So whether or not it's a requirement of law, body cameras, or recovery of removal of masks, et cetera. But the White House and Chuck Schumer are going to have to be debating that over the next week. But I will just say is the Senate's not supposed to come back for 10 days, and there really isn't a pressure point here until those first few paychecks start to go missing. So this shutdown could effectively last for DHS for the next few weeks.
Nathan, if I can go a little bit off piece, because I had a conversation that I've been thinking about for a bit a couple months ago with an asset manager who's very well connected politically that said to me, I think 2028, the main election topic and anxiety, and the thing everybody's going to have to address is AI, and AI leading to job losses. There's clear anxiety in this equity market, in Wall Street more broadly, about what the next target will be. Nathan, are there any conversations happening in Washington, D.C. about what policy responses might need to happen if people do face fears of jobs being displaced from AI?
It's happening in Congress. It's not so much happening at the macro level, but specific districts and specific Congress members of Congress are looking at it. So long story short is that you're not going to see a policy coming out of Washington in 2026 or 2027 that is going to be restricting AI. There is debate, however, at the states. For example, New York just is proposing a bill right now banning or putting a moratorium, if you will, on data centers associated with AI usage when it comes to electricity and energy costs. But all that being said is that Washington is really taking a hands-off policy towards artificial intelligence, and you're not really even seeing it at the regulators in terms of examination risk or anything like that. So, I do anticipate this will be something that Congress and Washington responds to, but we have to see the American populace start to bring it up as part of maybe the midterms or, like you said, the 2020 election before they actually come back and say we need to have a serious look at it.
Nathan, thank you so much for joining us today. Looking forward to reading your outlook for next week. That's Nathan Dean of Bloomberg Intelligence. Still ahead on the show, private credit's massive software bet is bigger than it might seem at first look. We're going to discuss the findings of a Bloomberg News review of BDC holdings. That's coming up next. Stay with us for that after this break. Let's get to high interest, a look at what's making headlines around the world. The Defense Department document that listed companies including Alibaba, Baidu, BYD, Huawei, and NIO as being tied to China's military has been pulled from the Federal Register. The Pentagon says an agency letter requested its withdrawal after public inspection. In a statement to Bloomberg News, the department says it has nothing to announce at this time. Shares still, though, lower of all those companies. Elon Musk's bankers are weighing a refinancing plan after SpaceX merged with xAI, aiming to cut interest on nearly $18 billion in debt tied to Twitter and his AI venture. Morgan Stanley is expected to lead the effort as Musk eyes a potential SpaceX IPO later this year. And Blackstone's private equity fund for wealthy investors surged 20% last year, with nearly a third of its returns driven by AI bets. The fund holds stakes in SpaceX and OpenAI, Anthropic, recently boosting its Anthropic position to $1 billion while expanding energy investments to power growing AI demand. And elsewhere in private markets, private credit's massive software bet is bigger than it appears. Bloomberg reviewed thousands of holdings across major BDCs and discovered that at least 250 investments worth more than $9 billion were not labeled as loans to software firms. Let's get more with Bloomberg private credit reporter Olivia Fishlow, who is behind this story. Olivia, first of all, excellent reporting. I can only imagine how long this took you, first of all. So we're grateful for all the time you plowed into this. What exactly did you find?
So thank you, first of all. So we were curious around software and private credit and hearing a lot of different numbers, and we're wondering, okay, what actually is their exposure to software? And so private credit has these funds that are publicly traded, and they have to release their list of investments through filings. So we went through 7 funds and tried to compare their software loans. And what we ended up finding is that a lot of these loans are labeled as software in one fund, but then in another fund they're labeled like a food product or specialty retail or something like that. And we ended up finding over 250 loans worth more than $9 billion that were not categorized the same between funds.
There seems to be a little bit of irony about it, because I remember a time when everybody wanted to call every single one of their companies like a tech, a cloud, a software company, that there was this desire to label it that way. How much of this was in the foresight of not trying to scare investors versus just an oversight from these companies of not being consistent with labeling?
Yeah, it's a great question, and it is hard to answer because right at one point software was the hot investment. But I think in the past we noticed that it's not only software that changes between funds. There's also consumer investments that maybe are labeled differently. And you remember a time when private credit funds were really defending, we're not in consumer, we're in software. Right. So I think it's definitely hard to say why it's being done, but I feel like you can sort of draw conclusions from that.
When might we see, because at the moment a lot of these BDCs are trading down quite significantly, is there a period where we could expect to see some more marks to market to see where pain might actually exist in some of the software bets?
Yeah, I think that it's something that obviously investors are asking for from these BDCs, and they're looking very closely at their marks. I will say, what we've heard from these lenders is that they're not really seeing pain within their software companies. They're saying they're still performing well. But obviously, I think the question is we don't know where AI is going to go. We don't know how it's going to develop. So it's sort of like what will happen in the future.
Are you seeing that translate into real, not just skepticism, but actually money flows? Are BDCs maybe receiving more withdrawal requests, or just investors less willing to put money in there because of some of these software fears?
So we're definitely seeing on both fronts redemption requests increase. So more investors are trying to take money out, and there's less money coming into these funds. It's hard to say whether or not that's specifically related to software, but I think it is sort of around this idea of what is really in these private credit portfolios.
Well, taking a Blue Owl as an example, on one side, maybe some software exposure, but they're also on the other side of things, of trying to build out AI, the very thing that might disrupt some of their other holdings. Is there a world in which software disruption bleeds into their willingness to lend otherwise? Because it does feel like private credit has been a really big pillar of these hyperscalers being able to build out all of the AI data centers we've seen.
Definitely. Yeah, I think they definitely do feel strongly about their software conviction, and they also feel strongly about their data center conviction. So I think it is time will tell, do those two bets kind of contradict one another?
All right, Olivia, thank you so much for joining us. Again, really excellent reporting. I suggest everybody go out and read that story. That's Bloomberg's Olivia Fishlow. Let's get a check on your equity markets. Are we seeing AI anxiety? It is just so much chop for this S&P. 0.05% to the downside. It would be the fourth consecutive day of a decline. It would be the first time that we've done that in 2026. There was one day this week where we only dropped 0.005%. So we've seen other days that have been even more flat, but we declined more than 1% yesterday. We are on track for a weekly loss of 1.5%. That would be the worst week since November 21st of 2025. And that's all happening despite the fact that yields are coming in. The 10-year yield, that is down by 3.6 basis points this morning. CPI comes in. It's mostly in line. There you go, across the curve. The 2-year yield, you can see why that's down more, down 4 basis points. We started to price in more rate cuts. We're now betting on 50% odds that we will get 3 rate cuts this year. But that's not seemingly helping stocks. There's some skepticism, maybe underneath the headline of the CPI data. It wasn't as sanguine as believed. Coming up on the show, my favorite topic, I think, data centers in space. Is it sci-fi or reality? We're going to discuss it with a man who knows the answer to that. It is the CEO of Phantom Space, who is working on this arms race right now. That's coming up soon on Bloomberg Open Interest. Data centers in space. It sounds like science fiction, but billionaires like Elon Musk and Jeff Bezos are weighing the idea as the AI industry expands. Here's what York Space CEO Dirk Wallinger had to say about the possibility.
There's some things to work out, I think, before that becomes a reality. All that said, are we working on those capabilities? Do we have platforms today that can do that? I mean, absolutely. If we can get the cost to pencil out, we absolutely have that capability. And, Elon is someone who has figured out very challenging problems in the past. So, we're never going to underestimate that. We're always going to keep an eye on kind of the capabilities are there and if they're possible.
And let's talk to someone who is also working on that very problem. It is Jim Cantrell, a founding member of SpaceX and the CEO of Phantom Space, which manufactures spacecrafts and launch vehicles and is building orbital data centers called Phantom Cloud to run AI and data processing in space. Jim, this is quickly becoming my fascination because it does feel like sci-fi, the idea that you could have data centers in space. How far away are we from that being a reality?
Yeah, well, first, welcome to the club. I've been thinking about this for about 10 years and have been filing patents in various different companies for data centers in space. And it's a reality. I think it's a number of years off, like my good friend Dirk said. What we're doing at Phantom Space is the idea eventually of creating a space app store in space where our children, our grandchildren, billions of people around the world can run code from space, much like your iPhone, and create great value from that data that's generated in space. The others that you mentioned, Elon and so forth, are thinking about taking these big data centers and putting them into space because of the power and the environmental impact that lacks in space. And 2 different approaches and 2 different results. And I think what you'll see is over the next 100 years, the space economy will be seen as a frontier, much like the New World was 500 years ago. And this is part of the infrastructure that we have to build out.
So in building that infrastructure, what are the biggest bottlenecks? What are the biggest challenges you need to overcome? I'm guessing there might be some physics bottlenecks of actually getting things like data centers out in space, or maybe even building the space app store. What still needs to be worked out?
Yeah, so if you talk about data centers on the Earth, they're megawatts, right? And to date, individual satellites can probably only produce kilowatts worth of data center power. And the real issue, the real restriction bottleneck is launch. And there are very few companies that control launch. And from the beginning, Phantom Space, we built in launch into our business plan. And believe it or not, 25 years ago when I was with SpaceX, that was our original playbook we wrote, was build the launch vehicle yourself, build the satellites yourself, and you can scale a constellation. It's kind of like living on one side of a very large river like the Mississippi, and you can't get to the other side without a boat. The rockets are sort of the modern day version or future version of boats that cross the Atlantic or the rivers.
I have to say, I just have a lot of elementary questions about this, so please forgive all of my ignorance, because, again, it's okay. Fascinating to me. But what about, I'm assuming things need to be maintenance, that chips need to be replaced. Apparently the chip replacement cycle is something like every 5 years. Isn't that extremely difficult if all the stuff is up in space?
Yeah, it is. And this is why you have to control launch. If you look at SpaceX, they use 85-90% of their capacity right now for Starlink. And Starlink's a great worldwide internet system. When they start doing much larger systems in space, that replacement cycle will still be there. Technically, a lot of these chips can last 20, 30 years in space. Many of them have. But it's like your iPhone, after a few years, it won't run the software anymore. So you get a new one because it's got better chips. And so what we see is the future where spacecraft and satellites are replaced on a 5-year cycle. You let the old ones burn up in the atmosphere just to not create space junk. And that's why you have to control launch. Launch is the foundation of all these companies. So, investors, as they're looking at the future of space and where to invest, you look at those who control launch. And launch is a very, very high moat, kind of competitive moat endeavor. It takes a lot of time, it takes specific talent that's rare, and it takes a lot of capital to get there. So once you have that, again, you're like the countries in Europe that had an ability to cross the Atlantic and colonize the New World.
Are you talking with any of the big tech, the big hyperscalers about this? I know what you're trying to create is something a little bit separate about a space app store, but also building some of the infrastructure. I wonder, considering all the patents and technology you have you been approached by any of the hyperscalers who've been building data centers on Earth that maybe want to partner with you to recreate the same thing in outer space?
Yeah, we have on our board of directors the founder of Compass Data Centers, for example. So we have a tremendous amount of interest from that world. I can't name names, but we have several publicly traded companies that we're in deep discussions for both a very large investment in our Series C funding round, as well as some very large customer contracts that would extend into names that you guys all talk about all day long. So the interest is there. The problem in the space industry is there's a lot of people who just aren't credible, and you have to be able to sift through that. So I think that's the phase the industry is going through right now, is to try to find out who's credible. Obviously, the three you mentioned earlier are very credible. We're less well known, but I'm known as the father of the data center concept, so that tends to draw people in. We've got a very concrete, although quiet, plan we've been executing on for the last 6 years to get it done.
Okay, that's interesting, because here on Earth, not exactly the same conversation, but a flavor it's happening of you have, yes, data centers being built with active leases being signed by hyperscalers, by OpenAI, and then there's this other speculative build happening and maybe speculative energy being put on the map, and are we going to overbuild it? Does the same risk exist for space? If a lot of people are coming in and maybe not all of them are credible, is there a risk that we overlaunch satellites into Earth's orbit, that we just go too far in an arms race for data centers in outer space?
Yeah, probably not in my lifetime, because launch is still very scarce. Despite this gigantic vehicle they call Starship that SpaceX has been launching, there's just not enough launch capacity out there for the satellites that are being built present. So that's always going to be a choke point. And if you solve that, you still have, where you can launch from. I can't launch from a Walmart parking lot, so I have to go from federal ranges. And those are about over capacity at the moment. Very quietly, the U.S. government's trying to help solve that along with states like Arizona. We're trying to build a spaceport there. So I don't think that's going to happen. I think there's also a huge market that can draw into this that is really orthogonal to the terrestrial space data market. What we hear from the hyperscalers is they're looking for unique data, right, that they can use to train their large language models, and that unique data resides in space. That's why we're focused on the Space App Store and putting compute near where these zettabytes of data are being generated and not being used because they can't get it back down.
How does funding look for this? More broadly in AI and data centers, funding markets have been wide open, be it for the hyperscalers, be it for others. Does the same exist for the types of projects you're undergoing?
Well, if you're certain companies, you can almost raise an infinite amount of money. For most of the rest of us, we went through an asset bubble about 2021 and 22 that has burst and it's finally coming back. So it's been, for many, particularly involved with launch, very difficult to raise money in the private capital markets. That's changed. But what people are looking for are quality teams, and they're looking for quality business plans and something different than just building rockets, even though the world still needs all the rockets it can get. We think that will continue to improve. And particularly with this advent of AI and large language models and applying it into space, we think that's one of the killer apps, and I have for 10 years now. So I'm not really surprised. You just have to be patient in this business because it takes a long time.
Man, Jim, this is so cool. Thank you for joining us. What a pleasure to have you. Jim Cantrell, CEO and co-founder of Phantom Space. Let's get a check on your equity markets here back on Earth. And they are rising, getting closer to outer space. Not really. I mean, we're at 6,853, still a ways off of the record, but now we're up by 1/3%. A weird session so far this morning. The NASDAQ, that outperforms up 0.4% as yields continue to drop, down by 3.5 basis points for your 10-year yield at 4.06. The front end falls 4 basis points. Let's look at some of the single stock movers at this hour. Applied Materials, a surprisingly upbeat sales forecast as demand for AI fuels equipment purchases, shares up 12.33%. Expedia, they post the fastest fourth quarter revenue in 3 years. But look what shares are doing, down 4.7%. It is another company where AI worries are rife. Can I just go to my chatbot and say, hey, book me something, and then Expedia becomes irrelevant. Airbnb, though, that may be more resistant to AI. They reported strong bookings, delivered an upbeat revenue outlook, and they cited strong travel demand. Shares are up 4.6%. Coming up, that AI anxiety, it's hitting IPO markets. Wall Street broker Clear Street postpones its offering. We're going to have more on that next, but happening right now, it's the Munich Security Conference. Bloomberg's Francine Lacroix moderating a session on climate action with guests including California Governor Gavin Newsom. Watch that conversation live go on your Bloomberg terminal.
You may not believe in science, but you got to believe your own eyes. I mean, people are burning up, choking up, heating up. We have simultaneous droughts and floods. Historic wildfires. You know maybe little about California. You've seen those images of these wildfires. Talk about being as dumb as we want to be. Places, lifestyles, tradition, being wiped off the map. Greenville.
Clear Street, a Wall Street broker built on cloud computing technology, has postponed its IPO in the U.S. after cutting the size of its offering. For more on this scoop, we're joined by the scooper? No, that doesn't sound right. But the man behind the story is Bloomberg IPO reporter Billy Lipschultz. I'm so sorry for that, Bailey.
Scooper's cool. That'll be my new nickname. We'll roll with it.
Sure. Okay, wait. So what happened? Why did they pull the IPO?
They blame market conditions, which, if you look at their comps, pointing to Interactive Brokers, pointing to Schwab, companies that are falling under pressure around concerns going forward around AI. The big thing that stands out, though, is this is a deal that downsized their targeted IPO by about 2/3 before they pulled the plug on the deal. Normally, that's not good. You should be moving up and to the right as opposed to downsizing the deal. They initially wanted more than $1 billion. Then we're going to say, okay, $365 million, we'll call it even, and then ultimately kicking the can down the road. So a bit of the dynamics of AI uncertainty, but also it does seem like when I talk to investors, this was a company-specific specific issue.
What does it mean then to have this one? Also, we talked about lift off the Blackstone IPO that was delayed. Some of the bigger ones that were supposed to come to market. Is that a bad sign for the mega IPOs we're supposed to get?
I don't think so, because investors will create capacity for a SpaceX or an OpenAI or an Anthropic or a Databricks. When you look at some of these companies, the conversations I've been having is if it's not a great asset and it's not in an area that's insulated from AI, people don't want to pay up because it's not worth the risk, and we've been seeing that. You saw Aji downgrade their size, as you mentioned, Liftoff pulling the plug or at least postponing it. Equipment shares trading quite well. Forgent's trading quite well. Things in the industrials and consumer space are getting done and trading well. It's just that investors aren't buying everything.
But that also, I feel like, goes against the idea, the John Gray idea, that this is the year of the IPO, because if you can only list like the biggest, highest quality IPOs, that feels like it has been. That if you have something good, maybe it can IPO. But how can it be the year the IPO of smaller things can't come to market?
No, I think that's a good point, and I think that's been one thing that I think bankers and private equity in particular are thinking about, because if you're a Thoma Bravo, hypothetically, and you're heavily exposed to software, it's hard to, with a straight face, go to a JP Morgan or a Morgan Stanley and say, we think this company is worth X, and investors should pay that. If no one is really sure what the businesses are going to look like 6 months, 12 months from now, it's really hard to get investors to want to create capacity in their portfolio to take on those new stocks.
Well, it's just going the other way on Bloomberg Deals, which you so kindly joined me this week. Holden Spat of Thoma Bravo was saying things are looking cheap in public markets, and maybe we want to buy. But again, part of the narrative had been private equity, things are gummed up, and they're going to have to exit via IPOs. Does something structurally change if they can't use that route right now because of what's happening?
Well, we have seen this really for the last 3 or 4 years. We've seen dividend recaps. We've seen different levers that private equity can pull to either maintain possession of those assets or find ways to try to cash out some investors who want liquidity. But the big question is DPI. And if you're looking at a portfolio that's skewed to software, or to your point, it can only exit the huge industrial companies or the likes of a Medline, that's few and far between to actually meeting those goals and being the year of the IPO. So I think this is something investors and bankers are going to have to spend this lull that we're going into thinking about as people get their audits, because March, April, May is normally a pretty big window. It's going to be interesting if public markets do anyone any favors.
Still, the best anecdote of last year was some unnamed private capital investor day. Someone showed up with a shirt saying DPI is the new IRR, which is a pretty dorky and awesome joke. So what other IPOs on the docket? Is it starting to get quiet? Are there some more coming up that also maybe are even at risk of getting pulled?
So structurally, we're going into financial staleness. That was why the likes of a Clear Street needed to get out yesterday and trade today. So we're going to be expecting a few weeks of quietness just on the filing front, people getting their audits, talking to their bankers about valuations. We did see PayPay, which is a big digital company based in Japan. That'll be north of $10 billion in valuation. That'll be an interesting one to see come to the public markets in the U.S. Bankers and investors, though, really are pointing to industrials. So think Copeland, which is a Blackstone asset, Madison Air, which is a huge company and should raise more than $2 billion. Those seem to be the deals that will be in vogue, that we're focusing on, but we'll also be chasing everything around SpaceX and the goings of an OpenAI.
Can't wait to read more of your reporting. Bailey, thank you so much. That is Bloomberg's Bailey Lipschultz, who will and has frequently joined me on Bloomberg Deals every Wednesday at noon. Bailey, thank you very much. Now, coming up, we're live from the Munich Security Conference with an interview with the German finance minister. That's coming up next. You're watching Bloomberg TV. Happening right now at the Munich Security Conference, Bloomberg's Francine Lockwell moderating a session on climate action with guests including California Governor Gavin Newsom. Let's listen in.
And it's going to take a while if you want to get to full autonomy, maybe at least $1 trillion. But everything stands on your energy security. You're not an independent, autonomous group of nations unless you have full energy security. Switching between President Putin to President Trump, well, choose your own poison, Europe. I'm just saying that if you wind up with 80% of all your gas coming from one country, it doesn't matter if it's the United States or Russia, I don't think you're that autonomous. So my simple message to you is you have a bank of energy called North Africa, which is multiple times of anything which Saudi Arabia will ever produce, and it's right on your doorstep. the Kingdom of Morocco, it's a 14th century monarchy. It's a little stable. It's a little boring. That's perfect to develop very large energy systems in. So I'm putting a proposal to Europe now that we develop a fully green state in Morocco. We drive down energy prices, making Morocco one of the most investable nations on earth. That helps a huge amount with all your immigration issues across Europe. But it also helps Europe massively because it can drive the greening of Western Europe. Now, we can do this. We've proven it in our own company, Fortescue. Trust what someone does just as much, even more than what they say. We're doing it. We can take that model straight across to Morocco, straight across to Europe. Laying cables at 2 to 2.5 gigawatts of cable isn't difficult. We can do it in about a year. We lay 40 to 50 of these electrical cables, which we can do. It's within our balance sheet in the next several years. And we've created an energy supply for Europe approximating the scale of Germany. And so Europe, you reach to the Nordic countries and you got way more energy independent. And now I'm saying reach to your other neighbours, reach to Morocco, and reach to Fortescue. Fortescue will stand behind this and turn Europe green to have much more competitive energy prices. You'll be in command of your own destiny. You will not be a vassal state to anyone.
Lydia Pereira. What Andrew is saying is very right, and that's actually the case for clean technologies. I have been pushing for this agenda in Europe. California is a great example, but yet the investment on clean technologies, if we compare Europe and US, in the US there's still, even if Donald Trump is not engaged with his concerns for climate change, but still the venture capital on clean technologies in the US is double or far more double than the investment.
Bloomberg's Francine Lacqua moderating a session on climate action at the Munich Security Conference. You can watch that on Live Go, but let's stay with the conference because Bloomberg's Oliver Crook is there on standby with Germany's finance minister. Oliver?
That's right, Danny. We're here with the German finance minister and also the vice chancellor, Minister Klingbei. Thank you so much for taking the time. We've just heard from the Chancellor Merz, saying that the post-war order no longer exists, but he also says and warns at the same time tonight not write off the United States too fast. Can you help us hold those two truths in our mind and how to translate that into German policy going forward?
Yeah, I mean, Chancellor Merz was very clear, and I think he gave a powerful and very good speech that we have to become stronger in Germany. We have to focus on European sovereignty, means competitiveness, means being better in defense spending. And yes, he made very clear that this old transatlantic relationship that we all know from the last years and that is very important for us in Germany, that this time is over and that we have to focus on ourselves, but also make very clear to our friends in the United States we want to work together with us, we want to strengthen the transatlantic partnership, but for that we have to be stronger in Europe, and you have to deal with us in another way than you did in the last years.
And it has forced a lot of very difficult and uncomfortable conversations in Europe, ones that you have been a part of. Chancellor Merz has alluded to one of them about nuclear deterrence. He talked about basically the Germans not wanting to sort of change the status quo. He's also talked about wanting to have the strongest conventional military in Europe. Can Germany have the strongest military in Europe and not have a sovereign nuclear deterrent?
Yes. We have a cooperation with the United States within NATO on the question of nuclear deterrence, and he made also very clear that we spend now a lot of money in our military, and we didn't do that for the last 20 years. So now we have to really speed up when it comes to military spending, and this is what we have to do, but it's not about nuclear weapons, it's not about nuclear power.
And another area of sort of partnership and cooperation with the United States is critical raw materials. There have been a lot of meetings in Washington, D.C. between the Europeans and the United States. Is that American system enough in order to secure the sort of critical raw materials that Germany needs? Is that single program enough, or does Germany need its own, again, sovereign program?
I mean, what is very clear is that we are vulnerable on the question of supply chains, that we are vulnerable vulnerable on the question of raw material, on critical minerals, and we have to do something. We're starting now this debate in Europe. We started it in Germany last year. I give a lot of money as Minister of Finance to make us more resilient on this question, and I'm thankful that also the US is starting this debate, but now we have to bring the US and the European debate together, but we have to do it in a way that both sides profit from this debate and not that it's one side against each other. We have to lower our dependencies from China, but that cannot mean, on the other hand, that we now have dependencies from the United States.
So to that end, one of the things I understand that has been discussed among your government, I'd like to get your perspective on how this is advancing, is about changing the sort of critical raw materials, putting that into the bucket of defense spending, thus making it eligible for the unlimited spending of the release debt brake.
We haven't decided yet, but we know
that it's a conversation that is ongoing.
We know that we need money for it. We know that it's not good for our industry, but also not good for security if we are vulnerable on the question of critical minerals and supply chain. So that means we have to do something, and the best way is we can do it together with our partners from the United States, but we will see in the next weeks.
Okay, and also we heard from Friedrich Merz a number of times this week, including in Brussels as well, or I should say in Belgium. He says that I'm happy that Emmanuel and Macron agree with each other on almost everything. Emmanuel Macron has also spoken this week. Does he agree with Emmanuel Macron that joint debt is something that must now be evaluated in order to reach those very ambitious defense goals to achieve that European sovereignty you speak of?
You talk about Eurobonds and this question. We spend so much money in Europe in the moment on defense, and I think we should ask ourselves, how could we spend it more effectively? What can we do to spend the money more in the European market? And I think this is the debate we need in the moment, and no other debate.
And just a final quick question to you. We're 18 months out from the Draghi report. Not a whole lot has been done. If I speak to you 1 year from now, what is the one initiative you'd like to get over the line? Is it capital markets?
I hope that in Europe everyone understands that this Greenland moment was really a critical moment for the transatlantic partnership. Now it's up to us to speed up, to be better on the processes, to reduce bureaucracy, to do more on the field of competitiveness. And to me it seems that the most important people in Europe understand that we have to do something now. And so this is a very European moment. And I hope if we met again in 1 year, then I can say we did a lot of good things in the last 12 months.
And we've seen Germany taking a very strong leadership role, particularly on the defense spending. So, Vice Chancellor, thank you very much for your time. Lars Klingbei, that is the Finance Minister of Germany, and the Vice Chancellor. I'll send it back to you.
Oliver, thank you very much for that conversation. That's Bloomberg's Oliver Crook with Germany's Finance Minister at the Munich Security Conference. A quick check on your equity markets this morning, because we've been bouncing back between gains and losses, and we're gains now, up 0.2% for the NASDAQ, up just more than that, 0.25% as yields come in after ACPI mostly in line. And that does it for open interest. I know many of you have a holiday weekend out there, so enjoy that one. Again, as equities try to fight back from all of the AI angst, plenty of that out there. Hope you can escape it. Bloomberg Tech, that starts right now.